Welcome back. You're watching the 80 Money Show, and now it's time to take up viewer queries. But then before that, CPI for the month of January has come in at 6.5% higher than the 6% estimated by analysts. And we will decode the numbers and what it means for the Indian economy in a short while from now. But that's the latest number of CPI that's coming, which is slightly beyond the RBI's tolerable band. We move on, and there are plethora of funds available in the market to invest your hard-earned money, but how do you assess which is the right fund for your portfolio? What are the criteria that one should look at to help you navigate through this maze? We have on board Pankaj Matpal, MD, Optima Money Managers. Also, before we take up queries, we just want to ask viewers to keep sending us their queries on our WhatsApp number, which is 865-797-4571. You can also email us your queries on the moneyshow@etnow.tv. Pankaj, good evening. Welcome to the show. And we quickly move on to our first question, which is from Prateek. And he says that he's doing an SIP of 10,000 per month in Axis Small Cap, DSP Mid Cap, HDFC Top 100, and his goals are actually his one of the goals is actually to have a corpus of 1 crore plus in 10 years, and which is why he's made this aggressive portfolio. So how are the funds looking to you, and what about his corpus? How much more should he be investing?
Kavita, good evening. See, Prateek is investing 10,000 rupees per month in 3 schemes. It means 30,000 per month. And if I do a simple calculation at 12%, per annum, means CAGR of 12%, I'm assuming here because returns are not guaranteed. So in 10 years, he can accumulate around 67 lakhs. And if a target is 1 crore, so simply if he step up his SIP by 10% every year, then he should be able to accumulate 1 crore rupees in 10 years time. And as far as schemes are concerned, he has investment across large cap, mid cap, small cap, and schemes are good from the long-term perspective. He should stay invested and continue his SIP.
All right. Any changes in the fund mix?
No, as I said, he has investment across large cap, mid cap, and small cap.
Okay.
So he should continue with these schemes only and this allocation.
And the increase in the SIP amount should be divided in these funds itself. There's no need to add one more fund later on.
No, it's not required as of now. He did not have investment in international fund. So at this point of time, I'll not suggest him to add, but he should think from the long-term perspective that he should have some exposure in US equity fund.
All right. Next question is from Samiksha, and she says that she wants to know if an index fund is better than a large cap fund. And given the market's volatility, she wants to understand if she can park in all her money in an index fund rather than having an active large cap scheme. Time horizon for an investment is 5 to 10 years.
First thing is that all indices are not same. There are large cap index like Nifty 50 or Sensex or Nifty 100. But at the same time, there are mid cap or small cap indexes are available. So if the question is this, that a large cap index versus actively managed fund, I'll say both are equally important. See, when you invest in index fund, you expect returns similar to that performance of index. But when you invest in actively managed fund, you expect that actively managed fund will outperform the index. So if we talk about the time right now in this situation, I expect going forward, at least for 1 or 2 years, stock picking will play a major role. So considering that fact, if somebody invests in an actively managed fund, they can expect better returns than an index fund. So, and from the long-term perspective in large cap, we have seen that index have performed better than actively managed fund. So my suggestion to Samiksha, if she wants to invest for 5 to 10 years, she should have both kind of fund in large cap. One, she can have a Nifty 50 fund. At the same time, an actively managed large cap fund can also be added to the portfolio.
All right. So that's the answer for Samiksha. Next question is from Mr. S.R. Reddy, and he says that he's a retired bank employee, and over the several years he has invested in fixed income instrument. Now, for post-retirement life, he wants to understand if there are any investment instrument with low to medium risk where he can put in his money, and he's talking about investing around 5 to 10,000 per month.
See, if Mr. Reddy is referring this fixed income instrument like the post office schemes or FDs, etc. So I'll say that he has choice to invest in debt funds as well. And I expect that going forward, debt funds will perform better compared to last year because interest rates have gone up and yields have uh, gone up. I mean, so in this case, debt funds will also give better returns. But at the same time, to beat inflation, if conservative hybrid funds and balance advantage fund can be added to the portfolio, then he can expect little better returns. So he has to understand the risk of investing in equity or hybrid fund, because when we invest in hybrid funds, it means your allocation is in equity as well as in debt. So in conservative hybrid fund, because the equity allocation is up to 25%, so he can consider those funds like SBI Conservative Hybrid Fund or Canara Robeco Conservative Hybrid Fund. And also with a moderate risk, he can consider a Balance Advantage Fund or Dynamic Asset Allocation Fund. This is a category where equity allocation can go up to 80%, on in some cases up to 100%. So there is a little risk is higher compared to conservative hybrid fund. And schemes, I'll suggest ICICI Prudential Balance Advantage Fund and Aditya Birla Sun Life Balance Advantage Fund.
We still don't know his investment duration. Without that information, is it advisable to recommend a balance advantage fund, or should he be purely in debt?
See, I mentioned clearly that there's a higher risk in these funds. So if somebody wants to invest minimum for 5 years, then can be considered. As he has mentioned that he is a retired person and never invested in equity. What he mentioned means he has invested mostly in fixed income instrument. So if Mr. Reddy can take little higher risk, then he can consider. Otherwise, at least that conservative hybrid funds I mentioned, those should be considered before these balance advantage funds.
To our next question, and that's from Sohail. He says that he's been investing in mutual funds since last 2 years and wanted to know if it is wise to pick funds with low NAVs because that way he can get more units. He right now has HDFC Flexi Cap, Nippon Small Cap, SBI Magnum Mid Cap, HDFC Top 100. So what is your advice on the funds that he has in the portfolio and also the strategy of having funds with low NAV?
Kavita, this question comes many times that lower the NAV means more units investor will get. But let me clarify, it does not make any difference whether you have more units or lesser units. Suppose you are investing 1 lakh rupee and NAV is 10, it means you will get 10,000 units. If the NAV is 100, you will get 1,000 units. But if market performs well or scheme performs well, so suppose, for example, you get 20% return. So 1 lakh will become 1 lakh 20 only, whether the NAV was 10. So 10 will become 12 or 100 will become 120. So number of units will not matter. What will matter that at what rate NAV is growing. So I'll suggest one should consider a scheme with long performance history and is long-term good performance over price of that unit. So first thing that it does not make difference whether the NAV is lower or higher. So you should consider a good fund. And as far as portfolio is concerned, you have good scheme, but
right.
HDFC Top 100 Fund, I'll say that one thing that you already have exposure to large cap. Second thing, in the large cap category, this is not the fund I'll recommend you to have in your portfolio.
Okay.
So you can replace it with the Canara Robeco Value Fund or ICICI Prudential Value Fund, Value Discovery Fund. So, and rest of the funds you can continue.
All right, Pankaj, that will be all. Thank you so much for being on the show and helping our viewers with their financial portfolio. But